Being both a dividend growth investor and an income investor who's pretty transparent with what I do, I'm often the target of a lot of criticism here on YouTube for my style of investing. So in this video, I'm going to go over the 5 most common criticisms I receive from people who are opposed to dividend investing and income investing, and I'm going to give my own response to each one. I do want to make this clear though, at no point in my channel's history have I ever said that dividend investing is the superior way to invest in the stock market for everyone. But I have said in the past that it is the best way to invest for people who like monthly and quarterly passive income through receiving distributions. But it's my belief that different people will have different preferences when it comes to investing. Some people prefer index funds while others prefer growth stocks. Some people like trading and some people like myself prefer holding dividend-paying investments. As I've always said, you should go with the investing style that motivates you the most and makes you the most comfortable. I don't oppose other forms of investing with the exception of gambling on highly speculative stocks. But today we're going to look at the 5 most common criticisms of dividend investing, and I'm going to give my own response to each one. So with that being said, let's go ahead and get started. A popular argument against dividend investing is that dividends are not guaranteed. Therefore, people should not invest for dividends because they can be cut at any time. It is true that no common stock is required to actually pay out dividends, but depending on the company, many are actually required to pay out a large amount of their revenue to shareholders in the form of dividends. For example, real estate investment trusts, business development companies, and royalty trusts are examples where they're required by law to pay out 90% of their earnings to shareholders in the form of dividends. If they do, then these companies are exempt from paying corporate taxes. So these businesses do have an incentive to pay out dividends, and rather much larger dividends. But still, despite this requirement, this does not guarantee that these stocks will still pay dividends. I remember during the pandemic that some hotel REITs stopped paying dividends altogether because with the lockdowns, they were losing money. Depending on oil prices, royalty trusts can also go long periods of time without declaring any dividends. So technically, these dividends aren't guaranteed on common shares of stock. The same goes for ETFs and closed-end funds that hold bonds and other interest-bearing investments. Although bonds that are highly rated, like AAA, are almost always considered safe, their distributions can't be 100% guaranteed, and therefore some examples do come to mind when AAA investments fail. The same goes for preferred shares. Even though preferred shareholders get a higher priority in terms of dividend treatment, if a company is failing, then the dividend can get cut from preferred shares too. But I don't believe the fact that dividends aren't guaranteed is a good reason to not pursue dividend investing, because no investment performance is ever guaranteed. People say that dividends aren't guaranteed, well, neither is it guaranteed that your favorite stocks and index funds will always go up in value. The safest investments are considered to be those that are backed by the US government, like treasuries. But even those can't be 100% guaranteed, even though it's very unlikely that they'll fail. It's for this reason I don't understand this argument. All investments come with risks and no performance is ever guaranteed no matter where you're putting your money. Another argument against dividend investing is that companies shouldn't even pay dividends in the first place. Instead of paying a dividend, a company should use the money that they have in their free cash and instead invest it back into the company. On the surface, this does sound like a good idea, and there are many companies out there that could benefit from this. If utility or tobacco companies, for example, didn't pay dividends and instead chose to focus on using that money to upgrade their facilities or offer new products, wouldn't that actually be better for the stock? Sometimes, yeah, that is the case. There are some companies that are going through a rough time and they would be better off cutting their dividends to improve their businesses. But people who make this argument, I think, are automatically making some assumptions. Like if a company uses the funds they have left over to instead keep it for themselves, that this will automatically translate into their stock performing better. This is definitely not true. Just because a company improves their facilities, introduces a new service, or pays down debt does not guarantee their stock share price is going to magically perform much better. Corporations make stupid decisions all the time that often do not benefit shareholders. If I was given a choice of receiving a dividend from leftover cash from a company I'm invested in or leave it to the company to use it however they think is best, I would always take the money, personally. Many companies have another incentive to issue dividends, which is board compensation. For the majority of stocks, the largest individual shareholders are the employees of the company, usually the board members. For many executives, a large part of their compensation comes through receiving dividends from the shares of the company they own. I know it's a really heated issue regarding how much these board members are compensated, but I don't see this trend changing anytime soon. Executives are going to continue to collect large sums of money through their own stocks dividends, so I don't see why we should avoid doing the same thing by being individual investors and buying our own shares of stocks. A third argument is that dividend investing isn't tax efficient, and because you have to pay taxes on your distributions, you should not invest in dividend-paying holdings. If you're investing in a Roth IRA, then you don't. End of story. The only time you ever have to pay dividends in a Roth, to my knowledge, is when you hold a large amount of shares in a master limited partnership. There is a weird law that does require you to pay taxes on some MLP dividends in a Roth, but that's the only situation I'm aware of. But every other type of dividend stock does not require you to pay taxes on your dividends in a Roth. With traditional IRAs, dividends aren't taxed when they're paid or reinvested, but are only taxed when you withdraw them at your current tax rate. But what about pursuing dividends outside of a retirement account, such as with an individual account? If you make the decision and determine that that's how you prefer to invest, then yes, you will most likely have a higher tax bill than people who don't buy dividend-paying stocks depending on what you buy. There are two different types of dividends, which are qualified and non-qualified. Qualified dividends are taxed at a lower rate than non-qualified dividends are. There are also tax-free dividend-paying options that exist depending on where you live, such as closed-end funds that hold municipal debt from your state. If you decide to invest in dividend stocks in a non-retirement account, then you will have to decide if that's the strategy that you want to pursue. If collecting dividends motivates you to save and invest more, which is what so many people in America aren't doing, then I say go for it. Collecting dividends and seeing them snowball over time is a really motivating way of investing more money. You never have to try to time the market with dividend investing. You don't have to fear about whether you're selling a stock before it's at an all-time high or if you should sell if the stock price falls another 5%. Just buy stable dividend-paying investments and don't worry about the daily movements of the share price. A fourth argument against dividend investing I see a lot is that dividend investing is boring. Instead of investing in dividend stocks, you should instead invest in growth stocks and in companies with more potential for explosive growth. This is the most childish criticism I see for dividend investing, and it's not even worth dedicating much time to. First, many of the most successful investors of all time have amassed huge amounts of wealth from boring investments. Second, investing in speculative holdings is more like gambling than anything if you haven't done your due diligence. As a dividend and an income investor, I'm more interested in cash flow from my investments and capital preservation. Staking my financial future by gambling in speculative companies is not something that I'm interested in doing, and I know more mature investors feel the same way. This is just a ridiculous criticism to have in my opinion. Finally, one more popular criticism of dividend and especially income investing is that reaching for high yields is dangerous. Investing in stocks and ETFs that offer yields much higher than the average S&P 500 stock is risky. This one does have some amount of truth to it. If you're only picking investments based on highest yield, then that is a lot riskier. Easily the most common mistake made by dividend and income investors is buying stocks with the highest yields without doing any due diligence. This usually happens when someone first becomes a dividend investor, but most people begin to realize that these stocks often lose a ton of value in their share prices over time. But when it comes to high yields, you actually have to know what is considered a high yield. In June, the average yield in the S&P 500 was 1.54%. While this might be average for a communications or a packaged food company, this is considered very low for REITs and BDCs, for example. It's not unusual for REITs to offer yields exceeding 4% and BDCs to offer 8% yields. And yet so many people believe that these yields are very risky, even though that for these types of companies, they're average. There's plenty of higher yielding dividend stocks that have never gone through a dividend cut. But it's really important that you know what's considered an average yield for a company. Don't look at a BDC that's yielding 8% and go, hey, that's much higher than 1.54%, it's automatically extremely dangerous. Whenever you come across a high yield, it's always good to look at their dividend history and see if they've been able to sustain it. If it keeps going down, then that's a good sign that you'll want to avoid that stock. So while I agree that you shouldn't grab the highest yields, assuming that a high yield always comes with extreme risk is incorrect. Again, just to reiterate, I do not hate other forms of investing. I don't care if this video persuaded anyone to change their strategy. I'm just giving my reasoning as to why I personally love dividend investing. Always go with the strategy that you prefer as long as it isn't gambling. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.